Your life savings can vanish, not from a crash, but from common mistakes millions make before retirement. These silent traps are real, and you could be falling into them right now. The question isn't just what they are, but how to stop them before it's too late. This video is your guide to protecting your financial future. Watch until the end, because everything you've built is on the line. Mistake 1. Not adjusting your investment portfolio with age. As investors approach retirement, a common yet perilous mistake is failing to de-risk their portfolios. Fueled by overconfidence from years of market growth, many middle-aged individuals maintain a high-risk, stock-heavy allocation, unknowingly exposing decades of savings to unacceptable risk. What serves as a powerful growth strategy in one's 30s and 40s becomes a high-stakes gamble in the final stretch before retirement. The fundamental problem is time. While a younger investor has decades to recover from a market downturn, someone in their 50s does not. A single severe market crash, like those seen in 2008 or 2020, can erase 30 to 40% of a portfolio's value in months. Such a catastrophic loss right before retirement can be devastating, potentially delaying financial independence by 5 to 10 years. The primary goal must shift from aggressive accumulation to strategic preservation. Adjusting your portfolio does not mean abandoning growth entirely. Instead, it is a strategic pivot from maximizing returns to preserving capital and ensuring stability. This involves gradually reallocating assets from volatile stocks into more stable vehicles like government bonds, diversified ETFs, and balanced funds. These instruments are designed to reduce volatility while still providing steady, reliable returns, protecting your hard-earned capital from market shocks. Implementing this shift requires a clear, proactive plan. The first step is to redefine your financial goals, clarifying your retirement timeline and required income. For those seeking a simplified approach, target date funds are an excellent solution. They automatically rebalance their asset mix over time, becoming more conservative as the target retirement date nears. For a more tailored strategy, consulting an independent financial advisor can provide a personalized roadmap. Regardless of the method, a regular portfolio review, at least annually, is crucial to ensure your investments remain aligned with your long-term objectives. Ultimately, clinging to a high-risk strategy in the pre-retirement phase is a failure to recognize that the game has changed. The objective is no longer to win big, but to ensure you don't lose what you've already won. By proactively rebalancing your portfolio, you shift from being a passenger in a volatile market to the pilot of your financial destiny. This disciplined approach is not just a smart financial move, it is a necessary one to secure the stable and timely retirement you have worked diligently to achieve.
Mistake 2. Failing to plan for healthcare costs in retirement. One of the most dangerous and common assumptions many middle-aged Americans quietly make is believing that Medicare will cover all their healthcare expenses in retirement. But the reality is far more complicated. Medicare does not cover everything, especially major expenses like long-term care, expensive prescription drugs, or extended hospital stays for chronic conditions. If you're not prepared for this, the financial shock can hit hard in your 60s or 70s, just when your health is declining and your income is no longer what it used to be. Many people plan meticulously for retirement, investing wisely, saving aggressively, budgeting for everyday living costs. But healthcare, a factor that can single-handedly derail your entire financial plan, is often underestimated or brushed aside with false optimism like insurance will take care of it when the time comes. Assuming Medicare is enough without building in any additional safeguards. In truth, according to a Fidelity study, a 65-year-old couple retiring today may need up to $315,000 to cover medical expenses throughout retirement. And that's not including long-term care, rehabilitation, or in-home services, common needs as we age. Without a solid plan for these costs, you may be forced to withdraw from retirement accounts earlier than expected, or worse, sell off assets to cover unexpected medical bills. Many retirees in this situation realize too late that they don't qualify for Medicaid, yet can't afford to pay out of pocket either. It's a high-pressure, avoidable scenario if you prepare ahead of time. The advantage of creating a clear plan for healthcare expenses is that it puts you in control of your financial future rather than leaving it up to your health. Fortunately, there are several flexible, effective tools to help with this. One of the most powerful is the Health Savings Account, or HSA, which offers triple tax benefits: tax-free contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. In addition, many people should consider supplemental coverage like Medigap or Medicare Advantage to fill the gaps that basic Medicare doesn't cover. While not everyone needs these policies, evaluating your options based on your medical history and specific needs, especially starting around age 55, is a smart, proactive move. There's no denying it. Long-term care is one of the most financially burdensome aspects of aging. Services like nursing homes, home health aides, and assisted living facilities are not covered by Medicare, and average costs can run between $7,000 to $10,000 per month depending on your state and level of care. If you don't have long-term care insurance or a designated reserve for these expenses, those costs will land squarely on your shoulders, or worse, your family's. The real benefit of planning for healthcare costs is peace of mind. You won't have to panic over a $20,000 medical bill because of an unexpected diagnosis. You'll be able to maintain your lifestyle, continue enjoying retirement, and won't have to cut essential spending just to afford medication or hospital care. A retirement plan is not complete unless it factors in your future health. No one can guarantee perfect health forever. The actions you take today, opening an HSA, purchasing the right insurance, or simply setting aside a dedicated medical fund, can shield you and your loved ones from painful financial surprises down the road. The key is to act while you're still healthy and have time, because once problems arise, your options will be limited. Planning ahead isn't just a smart financial decision, it's a reflection of responsibility, self-respect, and care for your future well-being. In a world where healthcare is becoming increasingly expensive and complex, being unprepared can shatter your retirement plans with just one unexpected event. Don't let that happen to you. Start planning for medical expenses now, because the sooner you do, the more control you'll have over your future.
Mistake 3. Withdrawing retirement funds too early or at the wrong time. One of the most critical financial decisions in life is determining the right time to withdraw from retirement accounts. A poorly timed withdrawal, often made to solve a short-term problem, can inflict long-lasting damage on your financial security. While the temptation to access these funds early is understandable, it's a deceptive quick fix that unravels the very structure designed to protect your future. The consequences of premature withdrawals are severe. If you take money from a 401k or IRA before age 59, you face a dual financial blow: standard income tax on the amount withdrawn, plus a steep 10% penalty from the IRS. This immediate loss is compounded by a far greater invisible cost, the forfeiture of future growth. By pulling money out of the market, you sacrifice decades of potential compounding that could have doubled or tripled your investment, effectively erasing a significant portion of your future wealth. Therefore, timing is a delicate balance. The goal is to find an optimal window for withdrawals, avoiding the penalties of acting too early or too late. Waiting after age 59.5 allows you to bypass the 10% early withdrawal penalty entirely. However, waiting too long is also perilous. The IRS mandates required minimum distributions, or RMDs, from traditional retirement accounts starting at age 73 or 75 depending on your birth year. Failing to take these distributions results in a harsh penalty of up to 25% of the required amount, making indecision just as costly as impatience. Crafting a smart withdrawal strategy is essential for navigating this landscape and achieving long-term stability. This begins by creating a clear asset distribution roadmap that outlines when and how much to withdraw annually to meet your needs without triggering unnecessary taxes. A key tactic is to diversify your withdrawal sources, blending distributions from taxable and non-taxable accounts to lower your overall tax burden. Furthermore, leveraging specialized accounts can significantly enhance your financial resilience. Health savings accounts should be preserved for as long as possible, as withdrawals for qualified medical expenses are completely tax-free. Additionally, consider delaying your Social Security benefits if feasible. For each year you wait past your full retirement age, your monthly benefit increases by approximately 8%, providing a substantial and guaranteed income boost later in life. Ultimately, a disciplined withdrawal plan is the bridge between accumulating savings and enjoying true financial freedom. It protects you from emotional, short-sighted decisions and ensures you don't outlive your money, providing peace of mind for your later years.
Mistake 4. Carrying high-interest consumer debt. By the time most people hit their 50s, retirement becomes a serious topic. When should I stop working? Will my savings be enough to support my lifestyle? How do I protect the wealth I've worked a lifetime to build? While many focus on investments and saving, there's one hidden threat that quietly drains retirement funds: high-interest consumer debt. Unpaid credit cards, auto loans for that new car, or short-term personal loans may seem manageable at first, but they're invisible financial leaks draining thousands of dollars every year from millions of middle-aged Americans. And with credit card interest rates ranging anywhere from 18% to 30%, keeping these debts is like investing in reverse. Instead of making your money grow, you're watching it erode day by day. That's the core feature of this financial trap. Carrying consumer debt during your retirement preparation years doesn't just strain your mindset, it directly undermines your investment cash flow. Instead of funneling money into your 401k, Roth IRA, or emergency fund, many are forced to use their income, or worse, withdraw from retirement accounts just to keep up with interest payments on debt that generates no long-term value. But the damage doesn't stop there. Consumer debt also strips away your ability to take control of your financial future. You can't confidently plan for retirement when hundreds or even thousands of dollars are being siphoned off each month toward credit card or loan payments. This cycle often forces people to work longer than planned or prematurely tap into their 401k or IRA to pay off debt, triggering tax penalties and lost investment growth. That's why one of the most powerful advantages you can give yourself is to eliminate high-interest consumer debt as quickly as possible. Doing so doesn't just free up your monthly cash flow, it gives you the freedom to redirect those funds into smart, income-generating strategies, such as safe investments, emergency reserves, or additional contributions to a Roth IRA. Without the pressure of interest payments, you'll gain clarity, flexibility, and momentum toward your retirement goals. In fact, the age range from 50 to 65 is often considered your golden window for wiping out bad debt. At this stage, your income is typically at its peak, and your kids may already be financially independent. It's the perfect time to clear the slate and enter retirement psychologically and financially prepared, especially since income typically declines after retirement, leaving less room to recover from past mistakes. So what's the real benefit of becoming debt-free before retirement? It's not just about avoiding high interest, it's about entering your 60s without the mental burden of bills, without dipping into your retirement nest egg to cover minimum payments, and without sleepless nights over credit card balances. Every dollar you have at that point becomes yours to enjoy, invest, or protect, not something you owe back to a lender. Imagine this. Instead of sending $700 a month toward consumer debt, you redirect that same amount into a diversified ETF portfolio or simply reserve it for future healthcare expenses. Over 10 years, that simple shift alone could build a substantial cushion, giving you peace of mind, reducing your dependence on Social Security,
and possibly even eliminating the need to lean on your children later in life. If you're wondering where to start, begin with a debt inventory. List every consumer debt you owe: credit cards, auto loans, and personal loans. Then, choose a repayment strategy that fits your style. You can either tackle the highest interest first, debt avalanche, or pay off the smallest balances first, debt snowball, to build quick wins. Paired with stricter spending discipline and a commitment to not taking on new debt, it's entirely possible to be debt-free within a few years, even in your 50s. And never forget, retirement isn't the end of the road. It's the beginning of a new chapter, one where every financial decision impacts your quality of life for decades to come. Breaking free from high-interest consumer debt may be one of the most important steps you take to achieve true financial freedom, peace of mind, and joy in your later years.
Mistake 5. Failing to create a clear estate plan. Many middle-aged Americans spend their entire lives working hard, building assets, from a home to retirement accounts to long-term investments. Yet ironically, many of them never take a single evening to create a legally valid will. They delay it, telling themselves, "It's not urgent," or "things will work themselves out." But that hesitation has led countless families into bitter disputes, financial losses, and years of legal tension, all unfolding immediately after the death of a loved one. This is the dangerous feature of this mistake. Not having a clear estate plan, including a will, power of attorney, or beneficiary designations, can result in your assets being completely frozen. In the U.S., the probate process can take months or even years, draining tens of thousands of dollars in legal fees, taxes, and administrative costs. All of it simply because the asset owner didn't take one proactive step: planning. And it gets worse. If you become mentally incapacitated due to an accident, illness, or aging without a durable power of attorney, your family members won't be able to manage your finances. They can't pay your medical bills, withdraw money from your accounts, or make critical decisions on your behalf. That leaves your loved ones paralyzed, stressed, and legally overwhelmed, often in the middle of an emotional crisis. So what's the solution? Begin estate planning early and be as clear and detailed as possible. This is the advantage of preparing in advance. You ensure your assets are distributed exactly according to your wishes, not dragged through court, eroded by legal fees, or triggering conflict among family members after you're gone. You don't have to be a millionaire to need a will. If you own a home, have retirement savings, or simply want to leave something for your children, then you need a will, preferably notarized and accompanied by documents like a living will, medical power of attorney, and financial power of attorney. In fact, many states allow you to assign beneficiaries directly on bank accounts, investment portfolios, or insurance policies, helping you bypass probate entirely. And the real benefit goes far beyond money. It's about peace of mind, knowing your family won't fight, splinter, or suffer through a long legal mess over the assets you left behind. It's about control, choosing someone you trust to make financial or medical decisions on your behalf when you no longer can. And ultimately, it's a gift, not in dollars, but in clarity and care, a final message of responsibility, love, and foresight for the people you leave behind. Many people assume estate planning is something they'll get to later, but life doesn't wait. Accidents, illness, and unexpected loss can strike at any time. Creating a plan doesn't invite misfortune. It demonstrates maturity and genuine love. Ask yourself, what would your children do if something happened to you today with no instructions, no legal authority, and no idea what your wishes were? A will, a power of attorney, a simple, legally sound estate plan. Often it costs just a few $100s to put together, but it can save your family tens of thousands and spare them from months or even years of emotional and legal turmoil. Treat estate planning as a non-negotiable part of your retirement plan, just like saving, investing, or buying insurance, because the wealth you spent your life building deserves to be protected to the very end and passed on the right way, to the right people, under the terms you choose. Don't let a simple oversight undo decades of hard work. Remember, preparing for retirement isn't just about accumulation. It's also about avoiding the financial traps that can destroy everything you've built.
If you found this video helpful, be sure to like, subscribe, and share so more people can benefit from this message. Which of these 5 mistakes are you currently facing? Drop a comment below and we'll help you find the solution that fits your situation best.